Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Hello and welcome to Private Banking Strategies with Vance, Lowe, and Seth Hicks. Gentlemen, so good to see you. How are you?
We're just good, Eric. Great.
Yeah, I mean, it's been a little while. I'm excited to get back in the saddle, if you will, if you want to call it that, of the podcast. And you guys have been telling me that there's been a lot of questions. You've had some meetings and different types of webinars and things with clients, and they brought up some questions that you really want to address. There's a little bit of confusion out there. Once you get it one-on-one, they're clear. However, there's a lot of people that probably have these same kind of questions, so you wanted to address those. And you've given me a list of about 10. Are you guys ready to tackle that?
Let's do it.
We are.
Okay. And kind of what spurred this, from my understanding, is what banking policy is the very best one for me? That's kind of the first question. And that's what people have been wrestling with. So kind of set the foundation for this.
I'll start with this, and Seth, you can kind of kick in on holes that maybe I leave off. But when we deal with insurance, everybody has preconceived ideas, past experience, what they've been told, everything else. And they're dealing with what they think is very professional people who know what they're doing. But in the life insurance world, most agents are among the lowest paid people, in different job industries. And they're taught what to say. And one of the things they try to do is they're taught how maybe an illustration shows their company to be an advantage. And so they sell the importance of, you need to look at these numbers, you need to look at this picture and these illustrations, when in most cases, it doesn't have anything to do with what a person's goals are. And so everybody gets lost trying to figure out which one is the best for me. So that's why we've come up with this topic. Seth, you might have another couple of examples or something of why, people kind of get lost in this.
Sure. And we point back to the 7 pillars of private banking strategies, Eric. There are 7 cornerstones for which we provide these services: asset protection, financial privacy, tax-free growth, legacy transfers. And so, like Vance said, each person has their own individual motivations. Mm-hmm. And a lot of times when we compare one life insurance company to another life insurance company, it's illustrations, we're way off in the weeds. And that doesn't necessarily match someone's motivations for why they're structuring this plan in the first place. So that's kind of a general overview, and something that we have to keep in our awareness is that each person's individual needs is going to vary person to person. Their motivations are going to vary person to person.
Yeah.
Are you using your private banking strategies as a retirement strategy? Are you using it as a asset protection technique? Are you using it for both? So there's those type of questions are litmus tests for each family's structure.
Okay, so let's take a step back. Considering all that you've already said, 7 pillars, how it's all incorporated, let's break it down to the basics first. Explain to folks, what is a banking policy?
All right, I think that's a great place to start, because we need to understand and focus on what we're trying to accomplish. Banking policy is an old-time contract that used to solve the banking equation in the United States. I mean, today, we can hardly even imagine that the United States didn't have branch banking, a bank on every corner, okay? But it didn't. As a matter of fact, when I was growing up, they didn't even have a bank in our town. We had to go almost
Hmm.
30 miles to a bank in order to use that bank. So where did Americans park their money? They parked them in these contracts with life insurance carriers because that's where the beginning started. That's where all the money was put. And it was under a strategy of being independent, self-aware, self-reliant. Back then, when our country was being settled, people could cross, the country, go out into the wilderness, and they would survive.
Mm-hmm.
That's a lost art today. That could not happen today with, over 90% of the people, they would perish within the first 30 days. So let's explain the contracts, the policy today. They've evolved a little bit, and they evolve all the time. So we've got to talk about the contract not as what everybody thinks life insurance is, but more that this contract will work as a money warehouse. It's
Okay.
a safe place to store money until we can put it to work. The people that we teach understand that money has no value unless it's moving and working for us. People are shocked when they say, well, I've got 401ks, I've got portfolios in stocks and bonds and mutual funds. I'm sorry to say, your money is asleep, 100% asleep. You're trying to earn interest, but you have to keep that money in those accounts. It's the people who have the money that are going to make the money.
Mm-hmm.
And we use a doubling factor that they'll double money so fast, but they'll only pay the investor what they can get away with, and the investor takes all the risk.
Yeah.
So the components, we want to talk about that a little bit, because these are specially designed today. They have to be put together correctly. And it's all over the board. Everyone is out there now thinking about, hey, maybe I can sell more product using the infinite banking, idea, or private banking strategy idea, when in fact, what's critical, this is only the money warehouse. Okay. It comes along with the strategy of how do we bank? How do we use money? How do we get the money back?
Okay. So let's stop there for a minute, because that's a great point. Since learning from you guys, I was shocked, and I hate to admit that I like TikTok, but I'm on TikTok. Not me personally. I just like to watch things on TikTok, and I've heard more and more people saying, "Oh, you can be your own bank," and blah blah blah. But I feel 100% like you were just saying. It feels like a sales tactic. So let's talk about how that banking policy is put together, because as important as it is for all the strategies, let's talk about how that's put together, so we know how it's different than what people are just, that 60-second snapshot on TikTok that is going to change someone's life forever.
All right, let's do that. Seth, be sure to chime in on something if I'm leaving a hole, okay?
Sure. Yeah.
Make sure that we have an open mind here. So the contracts are put together. They are life insurance, but we reverse engineer them. It's not about solving your death benefit needs. You're told right up front, we are not going to solve any death benefit needs. Mm-hmm. But it will come with some insurance, but it will be the absolute minimum we can get away with without it causing a modified endowment. We call them MECs. A MEC would be an instrument that is taxable and traceable by government. If it is a non-MEC, then, we get all the tax, favored treatment on these contracts. So sometimes that bar moves a little bit. They move a little bit different with each company because government is not organized, and they've come up with the MEC numbers independently for each company. And so it's very hard. And that goes into looking at numbers and things like that. Every company is very hard. And when you're told to look at the illustrations, we're not even qualified to look at it. We don't even know what we're looking for. We see a number and we assume that, oh, that's a good number, and therefore it's better than the other companies. So let's make a decision on that. And it's like the difference of yield versus average rate of return. If you ask the right question, you get the right information. If you ask the wrong one, So the first part is ordinary base premium, ordinary whole life, designed to be paid throughout a lifetime. Okay, we need some of that. Our commitment to our clients is to build this contract so efficient that it will go over 100%, which means, like in year 5, if you knew that you had an investment that was guaranteed for a minimum amount of performance, that in year 5, every dollar you put in, you're going to make $1.05 or $1.10 or $1.20. How many of those do we want? Especially if it's tax advantaged. So putting one of these contracts together is like setting up a company. And we actually use all companies, all American history of business is stemmed from the experience of life insurance and base premium, base whole life insurance. A premium or a new startup company usually is not profitable until 5 years, 3 to 7 years. Okay. And it's that cash value in the base premium that appears somewhere between 3 and 5 year period. Well, that's only one component, and that's a small component. But the father of this idea, R. Nelson Nash, he did a lot of experimenting, and he came up with, you know what? We're going to buy one of these high cash value policies, and we're going to pay premiums for 5 years. And after 5 years, then we'll start the banking process, because then there's cash value and we can start using the money in our bank to self-finance things. Well, 20 years ago, when guys like me came on the scene, we wanted to speed that up.
I bet.
And so because we dealt with so many different companies and we knew insurance law and the advantages inside and out of different strategies for life insurance, we easily came up with, you know what, if you attach to that policy what's called a paid up additions rider, you can speed up the process. A long story short is that the proper mix would be a 60-40 split. 60% into a paid up additions rider for only a short period of time. And then the 40 in the regular whole life. And our successful clients wish that would be reversed. And the reason is we cannot get the paid up additions rider to 100% efficiency. You know, it taps out about 92, 94%. In every case, no matter where you go, no matter what the percentage is, it'll never, the amount that you have access to. But it is that rider means it will reach out and purchase life insurance in one payment and you own it outright. Never any more expense from that time forward. So if we were to have a $10,000 premium, $4,000 would be base, $6,000 would be paid up additions rider. And it's that rider that creates immediate upfront, what we're going to call business profit or cash value. Any startup company, if they could pull 50 to 60% out in year 1, is going to say, hey, we had a great startup year. Well, the market out there has picked up on that, and they figured out a way to change those splits, but it takes you away from banking and it puts you in the now moment. And so you'll see things on the internet that go, 90-10 splits. Oh, you need to put more into the paid up additions rider, or you're getting ripped off. Well, there's no money in there. It's just effective for the first year or two. But hopefully people are setting up these strategies for long-term lifetime. And these contracts, if they're good, all come out to be the same. I have all the different companies we represent, so I don't get lost in the weeds. I can't tell the difference between them really as far as the performance goes. So then we might add a little bit of term rider. The term rider, the effective is buying more permanent, and it allows Like the first contracts I did on myself, I had a little bit of term rider in there. And when I borrowed money out, I could pay it back plus the interest that I charged. So I could actually add back more into the policy than I borrowed out because it acts like it's permanent, the term rider, and it gives you that upfront boost. We only need that for like 4 years. And then we leverage off that. We go down to the lower amount, what the permanent or base premium in year 5. Now in year 5, it's the base can go over 100%. Now we've got a policy that's rocking along at above 100%. And so the cash value, if it's not caught up yet, it will. It's just a mathematical equation. Mm-hmm. But so, that has let's nothing to do with banking. Yeah.
Okay. So you were talking about the components needed for the banking policy. And so far I've heard whole life, right? And then you get the paid up additions rider and then a term rider. Are those the components you're talking about, or are there additional components as well?
Those are the main components. In special instances, there are additional components.
All right.
You may need waiver of premium. You may need a guaranteed growth rider.
So it's all individualized, like you said.
Right. Uh-huh.
Okay. All right. Well, I mean, obviously you guys have covered a ton of stuff before, and this is a great breakdown. And I've heard you say this before. I already know this, but I know this is a question that has come up. Will the contract make you an owner of the life insurance company?
Seth, you're qualified to ask that one. Answer that one.
Sure. Yeah, we focus on companies whereby you are an owner, mutual companies, and as opposed to stock companies. And there are a multitude of reasons for that, but ultimately, I mean, the companies that we're utilizing, they're all similarly situated. And as Vance said, over the long term, they're pretty much going to perform in the same type of trajectories. Some may outperform initially, but ultimately, years 10 and ongoing, they're pretty well leveled out.
Yeah, and the advantage of being owners is that you get profits. You get at the head of the line. You get preferential treatment. In all these cases, when you go to borrow money, there's only 2 questions asked ever. It's how much do you want? Where do you want it sent? There's no payback. There's no reason as to why do you want this money? If you borrow your own money out of a real bank, that's the first question they'll ask. And if they don't like the answer, they don't have to give you the money, even if it's in your account. Yeah. So that's why an advantage. So all of our companies will produce the ownership. So in addition to the guarantees, these are high guarantees. These guarantees pretty much track realistic market growth after taxes. So we're right there in the guaranteed market. This whole strategy and these policies are based off of the guarantees. So when we project, we don't project the profits that are coming in. Mm-hmm. But the key, and everybody needs to know, we deal with companies that have never not paid an annual profit. And they're called dividends, okay? And they can be added in or increased death benefit or whatever else.
Okay, you brought up death benefit. Earlier you said that you're not solving for death benefit, and we've talked about that a little bit before, but break that down a little bit for me, because the insurance has a death benefit, right? But you're not solving for death benefit needs.
Let's say we've got an average 45-year-old, they want to do $25,000 into their bank each year. The minimum death benefit, if they're really good and healthy, might be $500,000. Okay. Mm-hmm. And so that's the minimum, that we can't go below that, or we break this MEC rule and things are taxable. Also, you can't put more than when you started. When you set the contract, you never can put additional premium in. So if it's $25,000 a year, that's it. Can't put $26,000, or you can't put $25,001. We're that tight up against the MEC wall to be more efficient. Okay. So we back right up there. We don't leave any unnecessary expense. Annualized is absolutely critical. Life insurance deals with annualization. So everybody else pretty much deals in the rear. You invest everything, you get your profits at the end of the year, not life insurance. When you pay the annual premium, You get the profits and the cash value up front at the beginning of the year. Everything is up front. But when you borrow loans, they're going to charge you a year's worth of interest up front. The advantage is that as you make payments back into your bank, you want to pay yourself back for those loans. They have to pay back the unearned interest. So there's no difference in the money you're putting back in. You have 100% access, whether it's going for loan interest or wherever it's going. You have re-access to exactly, the same amount, if not more. So the dividends, the way we set it up at the beginning is we have it by paid up additional insurance, one-time payment, because that adds to the cash value and that increases the death benefit. I just looked at a 28-year-old. I just did one on these guys, and they're doing $20,000 a year. He's close to $1 million of death benefit. But if he just keeps track, he'll have closer to $5 million at death in death benefit because of the paid up additions. You can switch those anytime to cash, or cash value or whatever else. But this seems to be the best bang for the buck, and that's why we do it.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue, but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please call Private Banking Strategies at 817-200-4777 or visit us at www.privatebankingstrategies.com.
I want to go back to the policy illustrations question, because everybody is going to paint the best picture that they possibly can, right? And you already touched on the fact that it's individualized. How much can somebody expect, or let's talk a little bit about what will make that picture fluctuate, right? Because you can do a picture one day, but then Seth, before we even started recording, you were talking about how things can change, and all of a sudden that picture is going to change drastically. So let's talk about that.
Yeah, Seth, go ahead and get into that for us, would you?
Sure. So the illustrations are based on a particular person's health and their premium amounts that they're putting in, and they're doing calculations on a spreadsheet forecasting if things are made, exactly according to the illustration. But if money is borrowed out of the policy, you've taken policy loans out at a certain date, that affects the calculations. When you pay them back, how much you pay them back, at what time you pay them back, all affects the calculations. Whether you pay the paid up additions rider or you don't 1 year, we call them flexible. So let's say that cash flow's tight 1 year, you've got $100,000 premium, $40,000 is in base, which is a required premium, and 60,000 is paid up addition, and all you have is the 40,000. Well, that's going to affect the illustration as well. So all those variables affect the calculus of what's on that spreadsheet. And I don't think we have a single client that has followed precisely, exactly to the T, the premium payments and dates and times that are on an illustration. They're more of a roadmap, a guidepost that help people kind of analyze things. But where sometimes folks get off into the weeds is they want to compare illustrations, and they'll say, well, I have this illustration from XYZ, and it's, it shows me a far better value and benefit than ABC. But if you recall in my past comment, 10 years and beyond, they're all leveling out with consistent application of your variables. So people can get caught up in that. What's the best for me? You have to go back to the fundamental cornerstones and motivations for why you're choosing these structures. And that's really what you're building on, not an illustration.
Yeah, even like you were saying, XYZ, ABC, you're talking about between two different companies. So, correct. I mean, company A, B, C looks great with these variables, but you change some of those variables, all of a sudden the other company would be better because of those different things. And so I can see that this would be like kind of just chasing your own tail by having to try to compare these things all the time. That doesn't make much sense.
Yeah, precisely.
Exactly. And we have a practice. We are going to go, when a person says, yes, I'm in, I want to start the strategy, we're going to get a policy issued. And so we subscribe to several companies simultaneously to get quotes from all of them. And this is where the confusion comes in. Usually the one company falls in love with you, and there might be a company that has a heartburn because of the color of your hair, whatever it is, so we need to know that. And we like to know what the limits are. We like to know, what the flavor is of the companies wanting to do business, put a policy on this person. And that also is information for future growth, other strategies once we implement the program. So that's, one of the most confusing things is that people, they want to do the right thing. And so they fall back on what they've either been taught or they've been told. And as I do research in some of the other areas and some of my hobbies, everything is being told or taught on the internet, and it's not necessarily true. Some of it's just downright wrong.
Yep.
And so we all have to test that out, and we all have to do it. But this is where the advisor also comes in. You have to have faith in the ones you're doing. Your homework should be more on what that individual's doing, what the background is, what the success rate is, and what the income rate is. If you're dealing with someone who makes half the income you do, you're in the wrong place, first off. There's no reason. We teach, our people how to rank advisors, how professional people. The nice thing about the strategy, you don't have to do that anymore because you don't need a professional person anymore when you're dealing with your money. But normally when you're dealing with someone, we do a scale of 1 to 10. A 1 doesn't even know the topic. A 10, there are no 10s. That guy would walk on water. That gal. Okay. So starting getting paid for your efforts, learning enough so that you can share some knowledge is about a 5. And there's good sides and bad sides of some of that. A 5 thinks they're a 9. A 9, when asked that scale, I'm probably a 6. It's just the reverse. The 8s and 9s are the gurus, where you see other professionals going to for mentoring. And those are the people you want to deal with because they'll take the time to find out about you and solve the issues for you. Most of the 5s are taught what to say and, have a program they got to go through. And if they get outside that, they're lost. And you have to fit their program. And therefore, he's going to convince you that you fit their program. So you got to be a little bit careful of that.
So again, a lot of this can be muddy water, if you will. There's so much to think about and deal with. For those that are listening that are just starting this process, maybe with you, or are thinking maybe I should start it, and they've never even approached the question. We're going to get some contact information here at the end of the show, but I think the question we need to wrap up with is, what should you be focusing on? What should the listener or the person who's just starting to work with you, what should they focus on during the initial setup and the learning phase of banking strategy without all that other information bogging them down?
Well, Seth hits the nail on the head when we talk about the 7 pillars.
Okay.
This is a complete strategy, but it's an unknown strategy. It was on purpose left out of our education so that the banks and government would have control over our lives. This gives us the control and it makes us independent. So we have to learn. We have to be willing to learn the strategy. It's not focused on a product. Yes, we need a contract, to have our money in a safe place. Okay, that's why we have that contract, is that we get control, we get tax advantage. Okay, but the strategy of using money, being able to put it out there, our principal, and getting back all our principal, never spending it again, living the laws of money, the 10% rule, never spending principal, working off of a well-designed plan, are things that are consciously decided upon. people who do it win by default. They're not going to fail. But the people who don't complain, why am I where I'm at? Why am I so frustrated? Why is this? Nelson Nash, in his book, Becoming Your Own Banker, has 5 laws. Those are laws that need to be defeated on a regular basis. If you're able to do that, you win by default because nobody else can. And then the banking equation. People just are flabbergasted that, when we say, look, how would you like to get back 100% of your monthly expenses every single month? And if you got it back, would you then be spending your principal? And they say no. And can you really do that? We don't even have to be present. And it's not even going to take 20 minutes. And you'll have no shadow of a doubt. But it's not the way you're thinking today.
Yeah.
We want to end up with, Eric, we gave them a promise, and we're going to tell it to them now. What banking policy is the very best one for you? We're going to share that with you before we end.
Okay.
But Seth, tell them, I just touched on why this is so important with the 7 pillars. Give us a little bit more.
Sure. Well, Eric, you've got, certain high net worth individuals that are flush with cash, and they're feeling very unsafe with bank failures, potential bail-ins, which we've discussed extensively, but it bears constant discussion and repetition. They don't want their cash sitting in potentially failing bank institutions. They want them in a bulletproof fortress. That guy's motivations are much different than the single mom who's got $5,000, a year for a premium that she wants to parlay into real estate investment. So we have to analyze each person's needs case by case. And the 7 pillars are pretty much a 360-degree paradigm. And, people ask me, well, is this for everyone? I think it fits for everyone, no matter whether you're 80 or 20, whether you're rich or poor, that these pillars, these 7 pillars and motivations will fit within every person's motivations. And then how you structure it, we tailor it towards that person's needs.
Yeah.
So, but just to continue on that, and just to give kind of an example, like we talked just briefly about term riders. Well, one of the reasons we'll have term riders is for those folks that have windfall opportunities. A term rider is something that you sell a business, you have a crypto investment that parabolically cashes you in like the lottery. Well, where do you put that cash? We just told you that the bank's not a safe place, but the term rider gives you the option without having to requalify medically or financially to just convert that term rider into your whole and life policies. And so you can take that windfall, convert it straight in, and you've got a safe place for your cash. So that's just a kind of an idea or an example of one of the ways it might fit one of those people that we're talking about.
Yeah. Well, I want to share just a little bit of a story. Vance, you said earlier, and Seth, you were just talking about the unsafety of banks or the questions that they ask. I actually belong to a small chat group that is about watches. I love watches. I like to collect watches. I don't have any super high end watches. Someday, right? Someday I might. But I just love to see the posts. I love to see the conversations and learn more. So I was on that just last week. And there's a couple guys on there that are constantly buying and selling watches. They're collectors. They have huge collections, but they also do a lot of buying and selling and bringing watches to the forum. And one of them brought up the fact that he goes into his bank and he's had issues before when he'll try to pull out cash. He wants to make a cash purchase and he doesn't like to use his cards and things like that for that. He'll go to a show or whatever and he'll purchase a watch with cash because it's the thing that does it instantly. And he's had issues going in and asking for $20,000 or $15,000 because they ask those questions. And so there was an entire thread on how to answer if the bank answers or asks you questions, right? What are you going to use this money for? They can't say watches, right? Because that doesn't, the bank could flag that. Well, that seems suspicious, kind of like you were talking about before. So they said, tell them you're buying some appliances for your home. Tell them, anything but certain things. Don't say A, B, or C. And if you don't answer, one of the guys said, I tried not to answer. I said, it's none of your business. And they wouldn't let him get his money out. They called a supervisor over. It was a big to do. It took him like 3 hours to explain what he does. And then finally, he just kind of had to divulge, I'm making some purchases for resale. And they're like, okay. And I thought it was incredible that's actually currently happening, that they would withhold his own money, but they do. So the points that you've made today are golden. What closing thoughts do you have for today's podcast, besides the fact that we're going to give out contact info?
Okay. Well, I just want to end with the reason. As far as your explanation, it's the Dodd-Frank Act. Folks, you don't own your accounts at the bank anymore. You are not the owner. You're just an equity investor. The bank owns your money because of the Dodd-Frank Act, and they can seize it and take it and do anything they want with it. For now, they're accommodating you until they seize it, or if they seize it. That's why it's unsafe. Okay. As far as closing goes, we want to talk to people and tell people what is the very, very best policy for you as far as banking goes. Here you go. Now, you need to open your mind and think, okay, because that's what this process is all about. The policy that is absolutely very best for you, and Seth, you tell me if you back this up, is the policy that you put in force yesterday.
Makes sense.
Oh, I don't have that policy. Oh, second best will be the policy that you put in force on August 30th, 2023. What day is that, Seth?
Today.
Today.
Take
That's
action.
second best. Oh, you don't have it ready to do today? Then let's go to third best. Then we do it tomorrow, or fourth or fifth or sixth best. See, folks, the thing is, we trick our minds all the time and into the weeds, so to speak. We put off making, good decisions. I have people say all the time, yeah, I'm sold on this, blah, 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 but, I want to get all my answers, everything first. How do you describe water being wet? Unless you jump in.
Yeah.
Then you can tell if it's cold or not, or experience everything else. So, folks, it's just noise until you pull the trigger and you have it enforced. If you lose a year, you'll never get a policy anywhere close to what that older policy would have done. Okay. In our little book, we show how a penny doubled for 30 times equals over $5 million. What happens if you lose one day? You just lost $2.5 million.
Yeah.
Okay. The same thing with investing. It's the back end that counts, but you have to start today. That's the very best policy for you. You can always add, you can always diversify, but you can never go back. You can never reclaim, what you have. So hopefully, if we have our clients listening, they're smiling. Hey, I got that one. Okay. Because the future, they'll change. Since I've been doing this, since Seth has been doing this, they've changed these contracts, and each time they're a little bit worse, but they still work beautiful. Okay. They don't go back to what's in Nelson Nash's book. Nelson Nash's book really showed a lot of high cash value where we're very close to those numbers, especially doing the banking. We can't, the policies are a little more restrictive. They put a little bit less in there. So, folks, it's important that you understand as you learn and you listen that you act upon what you do and you leave the old behind. You leave the falsehood, the noise behind, and you just go forward.
All right, Seth, let's give them some contact information so they can get that policy today.
Sure. Yeah. You're going to find us at privatebankingstrategies.com. That's privatebankingstrategies.com. And there, when you hit our website, you're going to have an offer for our ebook that's called What the Banks Don't Want You to Know. That comes to you in a PDF or an audio version, your choice. If you like to listen to things on the go, we've made that available for you. And if that resonates with you, we invite you to listen to some more podcasts. We've got a whole portfolio of podcasts available to you on the website. You can subscribe in your favorite platform. and go through some of that content and listen to things that catch your eye. And if our ebook and our podcast resonate with you, then we invite you to take an exploratory call with Vance, where you begin to dig into how this might apply for you. Ultimately, that results in an 8-year analysis where there's quite a bit of work done for you, particularly with your financial circumstances, your family goals and motivations, where we've roadmapped this out and tell you exactly what to do step by step and get you rocking and rolling. That's our process.
All right. Fantastic. Gentlemen, great information. Thank you for answering questions. Those that are listening, you can always email in questions. Get to the website, find some contact info there for emails. Email some more questions if you've got more. And then I just encourage you to reach out and make the phone call to talk to these guys in person. Gentlemen, always a pleasure. Thank you so much.
Thanks, Eric.
Thank you so much, Eric.
You bet. And our last thank you will always go to you, listening audience. Thank you so much for tuning in and listening to the Private Banking Strategies podcast with Vance, Lowe, and Seth Hicks. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Vance and Seth come out with a new podcast, it'll show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually does help others find the show. Again, thank you so much for listening today. For everyone at Private Banking Strategies, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please call Private Banking Strategies at 817-200-4777 or visit us at www.privatebankingstrategies.com.